Good afternoon, everyone. Welcome to our November webinar. Today, we're going to talk about some changes in legislation and what we're expecting, the autumn statement, and also a brief overview of the current lettings market. I'm Greg Suman, Lettings Director of Martyn, Gerrard and President-elect of Property Mark, Arla, and we also have Mitch Young, Director of Tax at Fusion Consulting. I suppose everybody has been watching the news, and you can see that our expectations have been managed quite carefully with the interesting leak from the government that indicated we were going to get a capital gains tax change, a quite considerable one, and then ultimately that was less disappointing than many expected. Nevertheless, let's talk about the expectations of the Renters Reform Bill. The main change that is expected is the abolition of Section 21 notices, strengthening Section 8 grounds. Currently, there are mandatory and discretionary grounds. There is also a single system of periodic tenancies that we will see. Improving court proceedings for possession, the decent home standards, a new ombudsman for the private renters, and a property portal which will help enhance enforcement. So Section 21, or as many like to call it, the no-fault evictions. I personally very much dislike the term, because if there was no fault, why would any landlord want to evict their tenant? And there's going to be a two-stage implementation, like with most new legislation. New tenancies, after the Act comes into effect, will not be able to use a Section 21 notice. It will simply disappear. And existing tenancies will have a transition period. Normally, it is for a period of 12 months. I don't expect it to be any different this time. And during that transition period, the old rules will remain. So existing tenancies, you'll be able to serve a Section 21 notice if you can currently do so. After which, all tenancies will become periodic, and Section 21 will not be able to be used. So tenants will be able to give you notice, even if it's a longer fixed-term contract, but Section 21 will not be a route for possession. So how do you get a tenant out? You will simply have to have a good reason to get a tenant out. So, for example, if you are selling a property, that is a mandatory ground. You will be able to give notice. It'll normally be 2 months' notice after the initial 6 months of the tenancy, and you can simply sell. You will also be able to get the tenant out if you have a family member or yourself who wants to move back into a property. We believe that this will also be a mandatory ground. Again, 2 months notice. And of course, antisocial behavior. That one is a little bit more complicated, because you have, although it's just a 2-week notice to get a tenant out for antisocial behavior, the test for whether or not the tenant is being antisocial is a little bit vague at this stage. So we're waiting for further clarification on this. Another mandatory ground, which I think is very good, is repeated serious arrears. Currently, if a tenant is in arrears and pays off those arrears just before the court hearing, it is no longer a mandatory ground, and you cannot evict them. And that can carry on indefinitely. So the tenant always pays rent 2 months in arrears, and there's not very much a landlord can do about it. With the new regime, if there are repeated serious arrears, which means 3 times within the last 3 years, and the rent is 2 months overdue, then that will become a mandatory ground, and you will be able to get that tenant out. Hopefully, as a result of these grounds, tenants will take their responsibilities even more seriously. But as always, it's very important to do thorough referencing and make sure that you've got the right tenant in the property. So now may be a time to review your current tenancy arrangements in anticipation of the Renters Reform Bill becoming law. Please feel free to email me on gt@martyngerrard.co.uk if you would like some bespoke advice and are interested in joining the MG VIP Club. A little bit more about that later. Decent home standards. So I think every landlord will agree that properties that are being let out need to be fit for purpose and fit for human habitation. There is an act that has been in place since 2018, which lists the 29 potential hazards that landlords need to keep a close eye on. They include the usual damp, heating, running water, all the things that most landlords would expect. But I would highly recommend that you either employ a professional managing agent to stay on top of your responsibilities on that front, or carefully read the fact sheet that we have created with regard to the 29 hazards and how to stay compliant. The property needs to be let with reasonably modern facilities, so kitchens that are older than 20 years or bathrooms which are older than 30 years could land landlords in a little bit of hot water. So please see if it's time to upgrade your kitchens and bathrooms. Carbon monoxide and smoke alarms are already law. Any property let currently must have a smoke alarm on every habitable level and a carbon monoxide detector near boilers and where fuel can be burned, so any combustible appliances. Periodic inspections will become expected. They are already expected, but I believe that they will become law. And we always recommend taking detailed high-resolution photographs to back up those reports should you ever need to rely on them. There are also expectations that minimum energy efficiency standards will imply that no property below a rating of C can be let out after either 2025 or 2030. Currently, this is band E, and the estimate is that 40% of the private rented sector will need to have some meaningful improvements done to the property to bring it up to a lettable standard. It needs to be in reasonable repair, thermal comfort, modern facilities and services. We've also seen coverage in the news that a blanket ban on no DSS tenants, no housing benefit, and no pets practices will become legislated. It will make it illegal for landlords or agents to have blanket bans on renting to families with children or those in receipt of benefits. It doesn't mean that you have to let to every tenant on housing benefit. It just means that you need to think carefully about why you may want to decline it. And there may be reasons linked to affordability. You may need a private guarantor to co-sign the tenancy agreement, but all of that is worth considering now before it becomes law. And rather than having an outright policy to ban pets in a property, perhaps consider whether you would want to attract a tenant with a pet subject to references and perhaps a larger rent. And if you are withholding consent, have a reason why you may want to withhold that consent. For example, your lease, your head lease with your freeholder may prevent you from letting to a family with pets. That would be a good enough reason to decline. There's also talk about passporting deposits, but I think it's too early to talk about it because the devil's in the detail, and we need to understand how the government propose that a tenant can move from one property to another without raising a new deposit. It will be a sort of a bridging loan arrangement, but we need to see further detail on how that's going to be implemented. So, current market. This is a chart of the number of tenants to number of available properties that we have been keeping internally for quite a number of years now. You can see that between 2016, although you can't see it on this chart, but from 2016 to about 2021 June time, the ratio has been fluctuating between 5 tenants and 15 tenants to each available property. After the pandemic, when people started returning to London and realized that a lot of properties from the private rented sector were sold, that ratio started increasing quite sharply. And in less than 12 months, we've gone from 5.4 tenants to every available property to rent to 35 to 1. So almost a sevenfold increase, which has resulted in significantly higher rents. We have seen rents go up by as much as 50% in that period of time. Some of you may have listened to my podcast for the Financial Times, where exactly at that time, I suggested that there will be a window of opportunity for tenants to secure homes during the summer holiday season. And as predicted, the ratio dropped to 18 to 1 before it sharply rose even higher. And we currently stand at approximately 45 tenants to each property. These are unprecedented levels and will result in the rent continuing to stay very, very high. Now, a couple of things can happen that might affect that. If all of a sudden we see a significant increase in supply coming onto the lettings market, should there be a downturn in the housing market, which at the moment I'm not seeing much sign of, despite the higher interest rates, then yes, that may affect it a little bit. But even if we were to return to a ratio of 15 to 1, there will still be enough tenants for every property available. We had queues of people, similar to some of the memes you've seen on social media in Ireland, where people were queuing around a block. There were 100 tenants attending one viewing. Although we didn't reach those levels, one of our open houses attracted 80 inquiries, and we had to stop showing the property after we had booked 40 viewings. Unsurprisingly, the property went for over the asking price, and tenants subsequently moved in after 7 offers over asking price. So the market is still very, very good. There's a question here: are you expecting the demand to remain at the current levels? Yes, and if anything, I expect demand to increase as people are putting their purchases off, and also as some landlords are exiting the market because of the current tax regime. Mitch will cover that in a little bit more detail, and there will be a whole Q&A session at the end of our presentation, so please stick around. So the market is very, very buoyant, and I see no signs of that changing. Is it reasonable to expect double-digit rental growth like we've seen before? I'm not sure, but the rental growth will continue. And from the conference that we've had last week, where George Osborne, who was the architect of the current tax regime for landlords, where the intention was to level the playing field between those buying as an investment and those buying to live in. So a lot of the problems were caused as a result of that policy. The expectation is that rents will continue rising because the house building targets have not been met and are unlikely to be met in the foreseeable future. So with limited housing supply and increasing demand, we see rents remaining stable and continuing their rise. The rise that we've seen in 2022 is completely unprecedented, and 40% rent increases year on year are just unsustainable for tenants in the conditions we are currently living in, with a cost of living crisis and high inflation. Now, the current market, nobody really knows which way we're going to go. It tends to be sales versus lettings. So when sales does really, really well, lettings tends to slow down a little bit. In 2022, we've not seen that. Sales remained very strong, and lettings is going from strength to strength. The only problem we're seeing is that tenants are struggling to secure homes because many landlords have left the sector, which presents an opportunity for those currently looking to invest, and also those who are perhaps in a stronger financial position to ride out this Bank of England interest rate rise, which may be here to stay for a little while, but we haven't got a crystal ball, so we will never know, I suppose, until it happens. Also, just to remind everybody, please do not consider this webinar as any form of legal advice or investment advice. These are our opinions, and we're sharing them with you because so far they've been pretty accurate. So the retail price index is currently at 14.2%, and the consumer price is 11.1. Now, double-digit inflation hasn't been seen for about 40 years, and it is the sign of the times. With the Bank of England base rate being only at 3%, and seasonally, not seasonally, but historically, the interest rates have always been at a higher rate than inflation. And if you take one away from the other, we're currently experiencing negative interest rates of approximately net -7% or even higher. So in historical terms, interest rates are not actually that high. The problem for landlords is that it is no longer possible to fully offset your interest cost against your rent before you pay tax on it. But again, Mitch will be able to advise you on how you can mitigate that. Rent, we anticipate rent to continue rising, and the harder it will be for the sales market, the more demand we expect on the letting side. Of course, that is subject to there not being a flood of properties coming into the rental market like we saw in 2008 following the Lehman crash. I do not expect that to happen. And house prices, there are many predictions on what's going to happen to house prices, but I think it's very important to keep it in perspective and remember that long-term prices always go up. When they dip, it presents a perfect opportunity for people to step in and get themselves a good deal, as long as you can afford the monthly payments, or if you're fortunate enough to be able to invest without a mortgage. Now is a perfect time to look at what's around in the market, as yields are going up. The average yield in North London is currently between 5 and 6%. This is for a normal property. I'm not talking about houses of multiple occupation or ex-council properties where the yields are even higher. In this market, it's more important than ever to remember about rent and legal protection. I've touched on that earlier, but if the tenant has been referenced and they, even if they're the best tenant in the world, they can fall on hard times. We've seen significant redundancies with huge corporations like Amazon, Twitter, and many others. If your tenant loses their job and cannot afford to pay the rent and Section 21 goes, how will you pay your mortgage? How will you meet your financial obligations? How will you ensure that you are not at risk? The best way is to insure your rent through a rent and legal protection. And if you use Martyn Gerrard estate agents with all our managed services, you get rent guarantee free of charge for the first term. And with a fully managed service, you get rent and legal protection free of charge for as long as the tenant stays. So a couple of things to bear in mind there. And finally, MGVIP. This is a club. Everybody who's on this course qualifies to join free of charge. I can provide more information if you'd like to get in contact with me personally on gt@martyngerrard.co.uk. So I hope you enjoyed that. There will be Q&A, and I will now pass to Mitch Young, Director of Fusion Tax, who will talk to you about all things tax related. Thank you.
Yeah, and thanks, Greg, very much. Apologies for the technical issues I've been having this morning. My computer's just crashed. So hopefully you'll see me in a couple of minutes. So just bear with me. So today I'm going to be covering the major announcements that were in the autumn statement as of a couple of weeks ago, and then also let you know about where the government policy decisions may be coming in the residential property market. So I represent my company, Fusion Consulting Group. We are an expert in everything property tax related. Please feel free to email me if you have any specific questions or queries in regards to property after today's webinar, and we'll be offering a free consultation to everyone on today's webinar. So the agenda, we're going to go over the autumn budget, the major changes to capital gains tax, looking at the income tax, and then towards the end I'll cover over some. So this webinar was quite timely, actually, because yesterday the Office of Tax Simplification produced their analysis on residential property and the interaction with taxation. You may have heard of the OTS, or the Office of Tax Simplification, before, because this was the major government body who put forward the suggestions to reform capital gains tax. So whilst there is a lot of thinking and I guess good suggestions, or some suggestions, historically the government have been slow to implement. You would have heard me on the last webinar we had with Martyn, Gerrard, and talking about the potential changes to capital gains tax, and there has been rumours for the last couple of years that will be brought in line with income tax, which obviously didn't happen. But what I'm going to share with you is 5 key findings from yesterday's report, which you may find interesting and could shape the policy in the future. The first is in regards to the tax rules in regards to furnished holiday lets. Furnished holiday lets are treated as a business, and therefore they have the benefits from a tax relief point of view. When you sell property, you can qualify for things like capital gains tax at the 10% rate. But what was very interesting is they put in this document wording around the creation of a statutory bright line testing for property businesses. So if you are a landlord or a portfolio landlord, it's always been argued with HMRC whether you actually have a business or not. Particularly, we do a lot of work with portfolio landlords who are looking at potentially incorporating their business. So that means setting up their limited company, moving their properties into a limited company for tax purposes. So if HMRC did come up with a statutory definition of what is a property business, that certainly would help everyone and give some real clarity into that position. They've put forward there some reforms into what is allowable expenditure for property, maybe continuing on the distinction between capital and revenue expenditure. One of the areas that they looked at is reforming the joint owners rules of residential property. So that is particularly around whereby if you own a property jointly, in legal terms, you can potentially change the ownership from a tax perspective via beneficial documents. And I can talk to you a bit more about that a bit later. And finally, I think what may happen is essentially the delay of making tax digital. So making that tax digital was proposed to come in for landlords as of 2024, and potentially they're now saying that until they get their processes in order, they essentially will look at delaying that probably by another year, I would say. So looking at 2025. And then finally, the reform of what is known as the non-resident landlord scheme for a tax purpose. So if we come on now to the autumn statement. Apologies, you can now see me at the bottom right hand side. So thank you for your patience. So the autumn statement, there wasn't huge amounts of changes that was brought in. The first was the additional rate of tax has been lowered. So the additional rate of tax, that is the amount of income that one can earn before being taxed at 45%. That has been reduced from 150,000 to 125,140 pounds. That will come in as of the 6th of April 2023. And as you can see from those statistics, it means 250,000 more taxpayers will now find themselves paying 45% tax. The personal allowances and all major allowances will remain frozen for a further 2 years. So that means the current allowances will be in place until the minimum of 2028. Now, this is the government's way of getting in more tax, because obviously with inflation, people earning more, statutory pay rise, generally they're going to be pushed into higher rates of tax, earning more money. But with the allowances, tax-free allowances remaining static, it's going to push more people every year to pay more tax. And that's the government's way of, rather than increasing the tax bands and marketing that, they call it a stealth tax. National insurance. So the national insurance thresholds were increased to be brought in line with that of the personal allowances. And again, the freezing of allowances will remain in place till 2028. So capital gains tax, this is probably the biggest announcement within the autumn statement. A lot of experts, to be fair, were predicting even more changes in this area of taxation. But if we just run through what actually did change. So currently, as well as your personal tax-free allowance, every year you have a capital gains tax allowance every year. And that is the amount of profits you can get from the sale of an asset without being subject to capital gains tax. Currently, that is 12,300. And now the government are cutting that from April 2023. So for the next tax year, that is going to be put in half to £6,000, and then halved again in the following year, 2024-25, to just £3,000. So from a planning perspective, if you are thinking about selling any assets, then looking at utilising your current capital gains tax bracket would be a good idea, or indeed gifting of assets. Couples allowance will be reduced as well from 12,000 to 6,000. And as you can see here, the statistics that the government put out, they aim to raise an extra £40 million by 2027 by reducing the capital gains tax allowance. So again, when we're talking about property, it's important we look at all the taxes. And if we look at the announcements for inheritance tax, again, more freezing of allowances. So currently the inheritance tax nil rate band is £325,000. That will remain in place until April 2028. So the nil rate band is essentially when you die, you have an allowance. All your assets gets added together, the current market value of all your assets, less debt, and whatever that net position is, if it is £325,000 or lower, then you won't have any inheritance tax to pay. If it's more than £325,000, you will have to pay inheritance tax, potentially at 40%. So inheritance tax is a very large tax, which one should look to plan for in their lifetime. The residence nil rate band will continue at £175,000. So that is when you've got your main residence, and if your assets total estate is below £2 million, you can benefit from an additional £175,000. So what that means is that you can have a total allowance of £500,000 if you've got a main residence and your estate is worth less than £2 million. Another statistic for you, the data published by HMRC in October showed a 400 million increase in inheritance tax income when compared to the same time the previous year. Inheritance tax is one of those taxes that if you do good tax planning within your lifetime, then you should be able to really make a big dent into any inheritance, and particularly look to mitigate it in its entirety. Okay, further reductions to allowances. So when we look at corporate entities, so if you're owning property within a limited company and you're looking to extract money personally from that company out of the profits, previously you could take £2,000 tax-free. That is called a dividend tax allowance. That has now, or will now, be reduced to £1,000 and then again to a massive £500. I mean, so that's essentially, regardless of your tax bands, those allowances are what they are, which is pretty crazy in terms of the reductions of the allowances. Moving on to stamp duty. So the stamp duty threshold to remain raised from 125,000 to 250,000, and for first-time buyers, the threshold has increased from 300,000 to £425,000. So those are the major changes, and I would expect further changes in regards to property to come into play over the next few years. And as you all know, when it comes to property, there's so many different taxes. It's important that you're being as efficient as possible. I've just listed some of the tips I've put just to briefly give you some food for thought today. So beneficial ownership. Not a lot of people are aware that from a tax perspective, the law differs from a legal ownership perspective. So what I mean by that is that you can have a legal owner on land registry, but the beneficial owner could be someone else, and you can allocate the income to someone else, and maybe a different family member at a different tax band. It may be your spouse or civil partner, and you can do that via a deed of trust. So consider beneficial ownership to other family members who are at a different tax band to you. Consider looking at a company option. Company options are interesting because mainly from the mortgage interest perspective. So as you are all probably aware, if you're a higher rate income taxpayer, you cannot fully deduct the amount of mortgage interest on your rental property. However, if that is within a limited company, you can fully deduct the mortgage interest and then pay tax at the true profits. So what you can look at is moving your portfolio from your own names into a limited company name. Of course, there is tax on all of that. There may be reliefs available, such as capital gains tax relief if you've got a business. There may be a stamp duty, land tax relief, or it may be a case of considering a company for future investments that you make. But just bear in mind, with a limited company, of course, we've just spoken about the dividend allowance being reduced, and we've got corporation tax rising. So it's really, really important for any decisions or future decisions, you crunch the numbers on all the options, or indeed, if the numbers aren't your thing, then speak with your accountant or tax advisor, or indeed, you can contact us. Use of family members. So I mentioned before, you may have children who are of the ages or reaching the ages of 18, and you may want to utilize their income brackets and their allowances, your spouse or civil partner, in order to be efficient, not only for today, but I mentioned from an inheritance tax perspective. The other thing you may want to also consider is the use of trusts. Trusts are quite popular, particularly in regards to inheritance tax planning, but also from a bloodline protection point of view. Today, we've been speaking about taxation, but from a legacy and protecting of your assets, having a trust within your arsenal is a good tool to have. So a transfer into the trust, there won't be any capital gains tax because a transfer into a trust qualifies for gift holdover relief. But you'll need to understand, if you're renting out the property, the tax position on having it within the trust, of course. But trusts are a good option to consider. And then, of course, if you are paying large amounts of income tax at the moment, it's important just to consider all the other tax reliefs that are available. Obviously, property is a great long-term investment, but there are tax reliefs available not associated to property, which you may want to consider in order to do things like increasing your basic rate band, such as a personal pension contribution, such as a charitable donation, which qualifies for gift aid. There may be other types of tax efficient investment so that you may want to consider, which qualify for tax reliefs, such as HMRC approved tax incentives, such as an EIS, a VCTs, SEIS, whereby you can make a qualifying investment and obtain tax reliefs. More and more important today is to, of course, seek professional advice, taxation advice, just to know your options and to ensure you're as tax efficient as you can be. So thank you very much. I'm going to pass over to Greg now to lead the Q&A. Please feel free to type any questions you have to myself or Greg in the chat bar.
Thanks very much, Mitch. That was great. Yeah, really interesting stuff. One question that I would like to ask everyone is going to be a poll that I'm just going to publish now. And it asks whether in the next 12 months you are likely to sell properties, buy properties, or do nothing. It would give us an interesting indication to see whether the new tax regime is prompting anyone to exit the market, or if in fact you can see the long-term benefits of being a landlord. And of course, we'll share the results with you afterwards. So please do engage. One of the questions, threshold being lowered so that 45% tax rate is now payable on income of 125,000. Mitch, this is for you, I believe. Does dividend income count towards that?
Yeah, so essentially the way allowances work is that all your sources of income will get added together. So if you've got property income, dividend income, employment income, pension income, all your income gets added together at the top of the calculation, and then you'll be taxed accordingly to your tax brackets.
Brilliant. So in that context, assigning the beneficial interest to a spouse could prove much more beneficial than it may have been before the announcement. So definitely worth having a conversation with a professional there. Another question, you anticipate tenants to property levels will drop, and why do you think that this will happen? I don't expect it to necessarily drop. I'm saying that that is a meaningful possibility because they are at absolutely unprecedented levels. And if landlords continue increasing, continue their investment, and there is more property coming on the market, should we simply return to the levels that we saw even 18 months ago, then with the same demand, the ratio of tenants to properties will significantly reduce. That doesn't mean that the rents will fall. We have a unprecedented supply-demand imbalance with tenants going to some desperate means to secure their rental property. So I wouldn't worry about that if that's the sort of your decision-making process, should you invest or not. Any property that we get on the market, we still receive on average about 60 inquiries per property, and that means that we are still letting every single property that we get within a very, very short period of time. Void periods with our clients are extremely low. Is tenant demand only limited to London? No, it is not. And in fact, we're probably seeing a few tenants being priced out of London and moving further out. It comes in waves. So initially central London is affected, and it pushes tenants to move out to zones sort of 3 around the Finchley area where we are very dominant. And then Further beyond that, we go past the A406, the North Circular, then we've got the M25 boundary as such, and then further and further afield, depending on transport links. My advice is always look at the transport links, look at the connections to get into the major hubs. Past performance indicates that investment in London generates generally a higher capital growth over the long term than outside of London, but yields tend to be higher in areas further afield. So it depends on your investment strategy and what you are really looking for. Mitch, this one's for you. Capital gains tax. Although annual rates cut, can you still aggregate 2 years of previous year's allowance if not used?
So no, I mean, you're not allowed. Essentially, your capital gains tax allowance, you can't, once you haven't used it, you can't carry forward any allowance. So that's a year-on-year allowance that you have to utilize in that year. One of the only places in which you can sort of carry forward an unused allowance is around pensions. So you're allowed to contribute £40,000 per year. If you haven't utilised that £40,000, you can carry that forward for a 3-year period.
Thank you very much. A question about non-resident landlord scheme changes. Could you expand on that, please, Mitch?
Yeah, well, I mean, it's hard for me to expand on it in the sense that it was only a recommendation in which the OTS made to the government that they should look at reforming it. They didn't go into huge specifics. I think what they were probably alluding to was the fact that with the non-resident landlord scheme, you have to withhold the tax at source. So I think what possibly could happen is that withholding of tax on a monthly basis, gets reformed, and then the landlord pays tax. Non-resident landlord pays tax in line with the new making tax digital regime, which will come in.
Thank you again. Question about rent controls. So this is a really interesting one. I understand that there's a very strong resistance from the Conservative Party to rent controls in general. They do not believe they work, and Kevin Hollinrake MP gave us evidence to the committee about that specific matter. Very informative if you were to Google it. I think it'll give you a lot of insight into how this could impact the private rented sector. Saying that, we are also seeing rent controls or rent freeze, which is even more draconian than rent controls, currently in effect in Scotland. So in Scotland, without any prior notice, they've announced that you cannot increase your tenants' rent, and you can also not evict them for a period of time. I believe it is currently being reviewed in March. So the effect it had on the private rented sector there is that landlords have simply pulled their property from the market, which is making it much harder for tenants to rent. Mayor of London is a advocate for rent controls. Despite all the evidence that is being presented, he seems to be still very keen on the idea. I think it will be absolutely detrimental to tenants, because if rent controls are introduced, landlords will become much pickier in terms of what tenant they will let to, and some will simply exit the market because it will become no longer viable. If your interest rates go up and you are unable to increase the rent to cover your outgoings, not many landlords would be interested in subsidizing their tenants' rent and continuing letting the property, as it were. I don't think it will happen personally, although it will very much depend on the outcome of the next election. And even if it does get introduced, I think that it will be a reasonable proposal to the rent control. So a limit on rent increases, being able to justify the rent increase with market comparables, and the introduction of the first tier tribunal to challenge those rent increases, is where we will need to be looking at, but I think it's a little bit too early for this. It is potentially on the horizon, but I wouldn't be overly worried. Not just yet anyway. So we've got some more questions coming through. Right, I thought you can carry forward 1 year only. I think, Mitch, this is in context of the previous question for capital gains tax being aggregated. I suppose you've answered that, but if you can just clarify once more, that would be great.
Yeah, so you can't carry forward any unused capital gains allowance on a year-by-year basis.
Okay, brilliant. I've got a detailed question here. I'm due to inherit a buy-to-let in London in February. I would like to refinance it and buy another buy-to-let. Before the ownership of the property is transferred to me, do I need to inherit it as a company I set up beforehand, or can I wait to put it in a company before I refinance it, or do I put it in a company before I rent it out? I am a higher rate taxpayer. Big thanks.
Okay, so obviously there's a lot there, a lot to consider. I think if we just break it down, you will inherit the property in line with the will of the deceased person that you're inheriting the property from. So that's likely to come from into your name, and then once it's in your name, is a question of what you do with the property. If you transfer it on the day in which you inherit the property, then there's unlikely to be an increase in capital value. You inherit the property at the market value cost at the date in which you inherit it. So then moving it or transferring it into a limited company, there's unlikely to be a capital gains tax position on that if you wanted to do it at that point. So it probably is into your name, then into the limited company. The only thing you may have to consider is obviously if there might be a stamp duty charge, and working out what that may be before actually doing that transaction. So I think the stamp duty, potential stamp duty tax, is the one that you need to calculate before setting your planned structure up even.
Thank you, Mitch. And another one, if you transfer property from individual to a trust, is there not a tax charge on value of property going into the trust and a 10-year charge? Can you explain more?
Yeah, good point. So I was alluding to capital gains tax. So moving the property into the name of the trust, there wouldn't be a capital gains tax because of gift holdover relief. And it will all depend on the actual value of the property. So I mentioned the nil rate band. So the nil rate band will apply to a trust as well. So that is £325,000. If the value of the property is within that, then there won't be a tax charge, an immediate tax charge in moving it into the name of the trust. If it's above that, then you may have what's called a chargeable lifetime transfer, which is essentially an immediate tax charge to inheritance tax, which is 20% on the amount above that, which you'll need to consider. And then, yes, every 10 years, the trust, the properties or the trust itself will need to be valued. And on average, it's about a 5 to 6% 10-year annual tax charge to have assets in a trust.
Brilliant. Thank you, Mitch. Another tax question. On selling a rental property which I previously lived in, what property purchase and sale costs can be used to reduce the capital gains tax liability?
Yeah, so essentially HMRC look at the period of ownership, and you will pro rata the gain for the amount of which it's been your main residence and qualify for principal private residence relief. So you should only be subject to capital gains tax on the period in which you rented out the property for. In terms of costs, associated costs, certainly things like buying and selling costs, so professional fees, solicitors' fees, stamp. Also, what's important is capital costs. So you may have renovated the property, you may have put on an extension, which is a capital cost, and these costs can be used to reduce the capital gains tax.
Brilliant, thank you. So we've got the results of the poll, and interestingly, 65% have responded to say that they will keep the number of properties as they are. 10% will reduce the number of properties they own, and 25% will increase the number of properties. So very interesting. So according to that sort of indicative poll, the taxation is still making investment in property a worthwhile investment, attractive for more landlords than not. I think it's important to bear in mind that tax changes can be introduced quite unpredictably, but last Friday at the conference, I was speaking to George Osborne, and he clearly accepted that although it was important to level the playing field originally back in 2015 when the policy was introduced, the pendulum may have swung in the other direction, perhaps a little bit too much. And with that statement, I'm hoping that there will be some tax concessions to landlords, which may coincide with the Renters Reform Bill, but these are my speculations, and I hope I'm right, because I myself am a property investor and a buy-to-let landlord. And just to remind you, if you would like to become an MGVIP, you will be very welcome, and you qualify for a free portfolio management overview with full legislative compliance review, as well as profitability and future-proofing your investment, and of course our periodic webinars just like this. Thank you very much for joining us. Thank you, Mitch. And if you've got any questions directly for me or Mitch, you've got Mitch's details, and you can contact me on gt@martyngerrard.co.uk with any questions. Please also register with us so that you receive notifications of future webinars. I hope you enjoyed it. Have a great day. Thank you very much.